The IMF talking about gold's role as money and not a barbarous relic, and its role as an international reserve currency, um, whether it be a vehicle or part of an international reserve system. You got the head of the IMF coming out 2 weeks ago and saying that CBDCs need to be backed by something in order to give them stability. You have all of the European central banks repatriating their gold from the New York Fed and the Bank of England. You have central banks buying more gold over the last 18 months than at any time in history, the biggest first quarter ever on record by the central banks. My feeling is that the only way that this really truly works is by pegging it to gold. But why now?
Breaking news here on Soar financially. The EU just announced a proposal for introducing a CBDC. I still have to read it, but I went through the first part at least, which means the reasoning of the issuing or proposing a CBDC. Really interesting stuff. All about trust. They fear that they're losing trust, meaning relevance. Really interesting. I'll discuss that later on with my guest here on the program, Andy Schectman, as well. He's the owner of Miles Franklin, and we've got a flurry of topics. He's been on at the end of February, right before the banking crisis hit. So we have a lot to chew through here on this conversation, and lots to sort of discuss on what the next 6 months will bring us. Really looking forward to this discussion because we rarely have bullion dealers on. So I'm also going to ask him about, of course, price developments of bullion, supply chain issues that we had discussed in the past as well, and premiums. Premiums. How much do you have to pay for a Silver Eagle these days, right? So really curious to discuss this with Andy. Andy, thank you so much for coming on again. It's good to see you again. Thanks for making the time.
Kai, I wouldn't miss it. Always great to be here with you, and I appreciate you having me, buddy.
Yeah, absolutely. As in my intro, I was like, I didn't even cover all the topics I wanted to discuss because it's so much we can, sort of chew through to or just come to today, not even discuss tomorrow, right? But let's start with a holistic approach, maybe to the whole thing. Is since you've been on at the end of February, we've seen the banking crisis, the debt ceiling has been raised. But in your opinion, like, what's the state of the economy globally right now? To sort of jump us off, and then we'll dive deeper.
I think in my mind, it's very, very fragile. You have a situation of higher interest rates globally, not just here. We saw what happened in Europe the other day. We're seeing rates rising in Australia and in Canada. We're seeing rates continue to rise, and the strain that's going to put on the businesses in an environment where we could argue really, the system can't take a whole lot more strain. I think we are nowhere near out of the woods, and I think that, quite frankly, the issue here, at least in terms of North America, is this continued fight between inflation and interest rates. And yes, they've raised rates very fast, about 10 straight rate increases to get to where we are at roughly 5%. But yet we're still below the levels of inflation. We haven't done anything to really tackle inflation. And they talk about this 2% inflation target. We're a good ways away from that inflation target. So the question becomes, where does the policy go? Does it go the way that it's always gone, where politicians choose inflation over austerity, over the tough decisions, or do they really raise rates high enough to start to really put tremendous strain, much more than we've already seen, not just on the banks, which I think are really in big trouble as this happens, but also on the businesses, the corporations who are having a hard time maintaining status quo, hard time in gaining access to capital at a reasonable rate. And I think we're going to see, as we get closer to the 24 election, at least here again in North America, an environment where rising rates can really, really damage the ecosystem. And what makes things worse is that the regional banks, which have seen massive outflows, which have really, I think, not gotten anywhere near out of the woods. In fact, there's in the neighborhood of $100 billion in this emergency lending program that the Fed set up to backstop these fragile banks. So we're nowhere near the end of it, but these banks hold 70% of all the small business loans. They hold approximately 70% of all of the commercial leases and loans on the commercial real estate. And all of these things being tied together in terms of accessing capital, whether it be refinancing leases or loans on property, or whether it be access to capital for businesses that are struggling in this environment, which the inverted yield curve tells us with a great level of predictability that we are going to see some sort of a recession on the horizon. Some people will go as far as to say a depression. Any way you look at it, to me, it feels as though we are in the eye of the hurricane, where we got bruised and battered on the front end of the storm with the banking failures and all of the fallout that ensued after that. But now it's as if everyone is looking to greener pastures. They're looking to an environment where maybe equities are on a bull run again. We're looking to an environment of a soft landing. And I would like to believe that that be true, but unfortunately I don't. I think the trailing edge of the storm is coming. And this is a moment where I think it would be a very big mistake to believe that we have crossed that line and are looking to growth and prosperity again in the future. Quite frankly, I think we're nowhere near that, and have a lot more to get through before we see that type of environment again.
Absolutely. Yeah. One thing I like looking forward to, or discussing, are potential shocks to the system as well. Banking crisis is one. Let's start there. In your opinion, is the banking crisis over? Was that just a blip? It was just a little hiccup in the system, and we're on, just regular day to day?
No, I think that it certainly is just beginning. And look, there at the beginning of 2023, there were 722 banks, according to the Fed, that were technically insolvent. There was a report done by some banking insiders who says that number is almost 3 times that. Like I said, there's $100 billion or more in this bailout program. It's not a bailout, it's an emergency lending program with very onerous terms for the banks that are taking part in it. But let's just take a step back and look at it for a moment. You have regional banks that failed, right? Silicon Valley Bank, Signature Bank, the second, third, and fourth largest bank failures in the history of this country failed, and they were all bailed out. Now, this is a point of contention. After the great financial crisis, we were told that these banks would not be bailed out, they would be bailed in, that the creditors, or excuse me, that the depositors would become unsecured general creditors of the bank and would be involved in a bail-in process instead of a bail-out process. And when the Fed, or in particular Janet Yellen and the Treasury and the FDIC came in, stepped in, and bailed out the banks, there was an inquiry. And the Republican senator from Oklahoma said to the Treasury Secretary, Madam Secretary, we're confused here. We were under the impression that when banks fail, according to the new laws, that they get bailed in, not bailed out, that the depositors become unsecured general creditors. And you just bailed out these banks. And she said, that's correct. He said, well, if one of the banks fail in Oklahoma, the regional banks, will I be safe to assume that my constituents will be made whole? And she said, no, probably not. He says, well, I'm confused. She said, listen, it will take an uber majority vote from the FOMC, which is the Fed, the FDIC, myself, and the President of the United States in order to determine if the banks are systemic enough to be bailed out. She lit a fuse under the banks. Now, you could argue that the Federal Reserve is aiding and abetting the exodus from these regional banks by allowing the money market funds, which are largely controlled by the commercial banks, which we were told are too big to fail, to invest their money market funds into the overnight reverse repo market, which is paying a higher rate than you can get in any CD with a 1-year time frame issued by a regional bank. The best you're going to do on a 1-year CD is 4.5%, and you're getting over 5% with safety in a money market fund with daily liquidity, because it's all going into the overnight reverse repo market backstopped by the Fed in a bank that's too big to fail. So the fact that they are allowing this to happen is part of the reason you are seeing a mass exodus out of the regional banks. But it's not just the regional banks, it's the commercial banks too. The big money is saying, why do we want to leave our money in these systemic banks that are between JP, Citi, and Goldman have $151 trillion in derivatives? And look, 1 trillion seconds ago was 31,688 years ago. There's no way to pay off or to print your way out of that type of a catastrophe. And so you're seeing the big money go directly to the Treasury, go directly into treasuries that are yielding a rate higher than you can find in a money market account, and backed by the government, backed by the Treasury, rather, or the Fed or the Treasury, depending upon where this is going, and without the risk, the systemic risk that we see with the regional banks. So yeah, I don't think we've even begun to see the end of it. And if I had to guess, they're not going to bail them out next time. Janet Yellen will let them fail, and we will see bail-ins, and that's what the law says it's supposed to be. That's when you lose everything over $250,000. Now, FDIC is a scam too. FDIC has somewhere in the neighborhood of $125 billion backing $18 trillion in deposits. You take the commercial banks out, $125 billion backing $9 trillion in deposits. How the hell does that happen? Not to mention the Fed lent FDIC $174 billion a few months ago. So FDIC, the backstop that we feel so warm and fuzzy about, is borrowing $174 billion from the Fed. They are woefully undercapitalized, trying to backstop a banking sector that is also undercapitalized and over-leveraged, filled with assets that have become toxic. This is a situation that is far from over. And when you take a further step back and take a look at one of the main advisories to the president, it's Lael Brainerd. And Lael Brainerd, who spent time at the Treasury, then went to the Fed when Powell was up for reappointment, was appointed number 2 at the Fed, and just left to head up an economic advisory group at the White House for President Biden. And her whole thesis when she ran for the head of the Fed was to remove the banks, to the abolishment of the banks, and go directly to the public with the Federal Reserve Fed token, directly to the public. And it's a full modern monetary theorist application. Her whole premise is modern monetary theory and get rid of the banks. Now, what's happening with the banks? Is the Fed aiding and abetting? Are the banks on the verge of mass consolidation? Well, I think the media wants you to believe they're not. I believe they are. And this time, in an effort to really push everyone into the handful of commercial banks, making it a whole hell of a lot easier to roll out your CBDC, which they are going to do, it's much easier to push it out to 3 or 4 or 5 commercial banks that are too big to fail, according to the Fed, or versus 5,000 regional banks. And if she wants that to happen, all she needs to do is, this time when a bank fails, let them be bailed in and not be bailed out. And watch the panic that ensues. Kai, we added 14,000 clients, new clients, in 45 days in March and April after the banks failed. And they were bailed out. Watch what happens this time when they are bailed in, and the level of fear and anxiety that will permeate through the system will have a rippled effect. And when you realize that these banks that are hanging on by a thread own the majority of the commercial real estate and represent 70% of the small business loans, all of which are getting squeezed, the small businessman and woman and the commercial real estate, in an environment where people don't need to be at work anymore, in an environment where rates are rising and these loans reset, there's going to be a lot of hell. And I don't think we're anywhere near the end of it yet. And again, eye of the hurricane. It's sunny out, must be over. Don't look that way, because the trailing edge of the storm is coming. And when it hits, I think this time it'll be a lot worse than what we saw with Silicon Valley Bank and Signature Bank and the other one that skips me the name of it, that failed.
First Republic, I think. But yeah, it's like the light at the end of the tunnel is not the sun, right? So
no, right.
Absolutely. Lots to discuss here. I want to shelf the CBDC discussion for just a few more minutes, because we need to talk about treasuries and Treasury Bill issuance, because I always like looking for the canary in the coal mine, right? And leading indicators and can the U.S. actually issue 1.1 or 1.3 trillion dollars worth of T-bills over the next 6 months, right? What's your sort of opinion on that? Because they're all short dated, high yielding. What are your 2 cents on that?
Yeah, I think they can, and that's where all the money that is leaving the system is going. You talk to people; they're loaded up with short-term treasuries instead of leaving it in the bank. They're layered in 6 month and maybe 1 year treasuries before the curve inverts. And so, yeah, I think that they can. And what is really interesting is that they're talking also about issuing somewhere in the neighborhood of 1 trillion in long-term bonds, longer-term bonds, that on top of the barrage, as you mentioned, of the Treasury bills that have been hitting the market and continue to hit the market over the next few months, this is what is driving the money out of the banks, including the commercial banks. But in August, they're supposed to issue up to 1 trillion in 2023 bonds, this year in longer maturity bonds. And what's interesting about that is that coincides with a report I just read from JP Morgan talking about the fact that the world's biggest asset managers could unload somewhere in the neighborhood of 150 billion in equities by the end of June. And all of that money is set to flow into bonds. And the reason they were talking about that happening is that they see a rebalancing of the 60-40 split between stocks and bonds, that the value of stocks has gotten, because of the run-up, has gotten disproportionate with their allocations. And so when you see massive entities ranging from hedge funds, mutual funds, all the way down to the Swiss National Bank, they all need to sell securities. It's rumored that the Swiss National Bank needs to sell upwards of 15 billion in equities just by the end of the quarter. Japan, $1.5 trillion pension fund, needs to sell 37 billion by the end of the quarter to rebalance between bonds and stocks. So there will be at least for a large portion of it, according to the article by JP Morgan analysts, demand for these treasuries and bills and notes and bonds that will be issued. And I think that is really what has been driving the strain behind the banks. Because why would you ever stay in a regional bank that can fail, that ultimately we've been told most likely will not be bailed out, will be bailed in, where the best you can get is 4.5% on a 1-year CD where you're locked in, versus going to a too big to fail bank that's going directly to the Fed in the overnight reverse repo market, paying 5% with daily liquidity. There's no reason to do that. And the super smart, big investors inside of the commercial banks say, yeah, I don't even want to trust the too big to fail. I'm going right to the Fed, and I'll just buy directly short-term treasuries and get out of the banking system, which is very systemic. And so, yeah, I do think, and it's funny because as the rest of the world sheds bonds, the US public goes deeper and deeper and deeper into it. It's an interesting phenomenon. So ultimately, we reach a point where I think, to your point, Kai, we'll have a hard time selling all of these bonds when it becomes evident that most of the world doesn't want our bonds anymore, doesn't want our treasuries anymore. They're moving elsewhere, as we're seeing a lot of them shed treasury positions. And either the Fed will have to monetize those bonds directly from the Treasury, which is the road to hyperinflation, or they're going to have to pay much higher yields. Either road leads to the same place, and that is much higher interest rates, putting greater strain on the system. And this is a problem that most people don't even see it coming. Hard to get out of the way of what you don't see coming, but it's people who do nothing but listen to the mainstream who would think that green shoots are on the horizon and the worst is behind us. And I would argue the worst is definitely yet to come.
Yeah, no, what you mentioned sort of fits with what I've been hearing as well, commentary-wise, is a lot of the hedge funds, the big funds, are just parking stocks right now in the top 7 NASDAQ or S&P 500 shares, or companies like the NVIDIAs of the world, right? That's why pushing them so much higher, because they don't know where else to put their money until like those bonds become available or other products, right, for lack of a better term. So
Yeah, and I mean, That's true. And to your point also, without the AI narrative, the stock market would be a lot more volatile, would show much less appreciation. You go underneath the surface, the majority of stocks are flat, down, or up 1 or 2%. They're not showing the growth that we've seen, which is dominated by a handful of stocks. And so you're right. I think they have ridden that up, but you're seeing just the other day huge outflows out of the Nasdaq. They're capturing their profit and they're moving it to something a little bit safer. I do believe this is a trend that we will see grow over the last few months of the summer into the fall.
No, absolutely. Andy, you've been mentioning the system is extremely fragile. You mentioned, Biden's advisor there as well, sort of all leading to a great reset, right? And you brought up CBDCs, and I mentioned it in my intro because top of mind, it was just announced, as I said, 6, 7 hours ago now, that the EU or European Union is now also proposing a digital currency to be introduced. Let's talk us through this. Like, I still have a hard time, honestly, understanding what a digital currency is, and maybe our viewers as well. I have to do a lot deeper dive. The proposal is going to be my nighttime, bedtime, sort of put me to sleep kind of lecture. But what is a CBDC? Because I use PayPal, I use other platforms like Venmo to send money. Why do I need a CBDC when I still can transact? And what's the difference to MasterCard and Visa?
Yeah, well, first of all, in terms of Zelle and Venmo, you got FedNow coming out supposedly next month. That'll be Zelle on steroids. And that is the precursor to a CBDC. You have 114 countries, Kai, representing 95% of global GDP that are either actively exploring or have already issued beta testing on CBDCs. And, you got the head of the IMF, Christina Georgieva or something along those lines, who came out recently and said that CBDCs need to be backed by assets, number one, or they become too speculative. And this makes me think for a moment about gold's reclassification as a tier one reserve asset and the fact that the central banks have bought more over the last 18 months than any time in history. They've all repatriated their gold from the Fed and the Bank of England, and for the last several years have been using Western suppression to fill their shelves of physical gold. But yeah, I think it is a reality. There is no question about it, but it's not something that we have a choice about. And you say, why do I need a CBDC? I don't think many people will appreciate having a CBDC. I think a cashless society is a very frightening thing. Now, Switzerland just came out and they are issuing their CBDC parallel to their cash system for those who want to use it. They want it to be real time. And they're not, it actually came out and said, we hope to never get rid of cash, but we're going to issue a CBDC at the same time. You have the IMF, who is coming out and talking about a bridge of sorts that will allow CBDCs to talk amongst one another. The reason they want it in the United States, in my opinion, has less to do, most people think it's that they want to have their thumb on top of everyone's actions and be able to control control spending, to know everything that is being spent. And that is true. A ledger would do that. But to me, the real reason they wanted to do it was explained by Lael Brainerd when she ran for the Fed. She said, look, there's no reason that we should be reliant upon the banks to create money. In other words, when the Fed creates money out of thin air, they have really only two things that they're supposed to do with it. One, buy US Treasuries. Two, buy Fannie and Freddie mortgage-backed securities. And they buy them primarily from the banks. When they come to the banks and say, hey, we want your treasuries, you got to sell them to us, they're obliged to do so. And they get paid money that was just freshly created by the Fed. Now, that money hasn't gotten out into the system yet. The banks have two options. They can either lend it into the system, credit card, mortgage, car loan, student loan, any way that you can think of that you get money from a bank, bang, you just created money out of thin air. That money that is lent into existence now is money creation in this fractional reserve system. Now, if the banks don't want to lend it out to you or I, Kai, because, well, Kai and Andy might be credit worthy, maybe, but the economy isn't, and we don't like what we see. In fact, I'll just give it back to the Fed in a reserve account, they'd say, paying 5% with safety, no risk. of Kai or Andy going bankrupt or the economy collapsing underneath them. We'll give it to the Fed where we can earn our safe return, even if it's less than we can get in a mortgage or 3 times less than we're going to get in a credit card or whatever it may be. It's with safety. So let's just be safe here. Well, Lael Brainerd said that's inefficient. And if the Fed wants to create inflation, they should be able to give money directly to the public, right to their iPhone on a central bank digital currency. And although she acknowledged it would be controversial, she said if we need to slow things down, we may have to take money from people. Modern monetary theorists go straight to the public from the Fed and sidestep the money creation process with lending it into existence by a network of banks. That's in my opinion, that is the motivation behind the Fed in terms of the government and their ability to control and taking it out as far as what China's doing with social credit score and whatnot. That's the frightening part. But the reality of it is when the Bank of International Settlements, the most sophisticated, well-informed, well-influential bank in the world, says everyone must have an operational CBDC by 2025, you can see when 95% of global GDP is actually doing this right now, it's becoming a reality and it's going to happen. And so I don't think we'll have much in the way of choices. And to your point, MasterCard, the Fed and I think 11 or 12 banks, including MasterCard, have been running a beta test for the last several months, parallel to the US system. And it's kind of been in the shadows. This was announced several months ago. That
I think Swift did something similar as well. I think we might have even chatted about it. I know I brought it up in 1 or 2 conversations before.
It's happening. It's coming. Yeah. That's about it.
No, I can definitely recommend anybody who's watching read part 1 explanatory memorandums, like context of the proposal of the EU, because I'm just going to quote actually one sentence. This trend could be enforced in the future with the emergence of a third country central bank digital currency and stable coins issued by private firms, which could challenge the role of the euro in payments in the EU and outside. I think that perfectly sums it up. They're scared that they lose relevancy in the Eurovols.
Yeah, well, look, why do you think you're hearing this right now? I'll tell you why I think you're hearing it right now. Before I mention that, let's go back about 4, 5, 6 months ago. There was a report that came out of the IMF that said gold, an international reserve currency, a barbarous relic no more, ? The IMF talking about gold's role as money and not a barbarous relic, and its role as an international reserve currency, whether it be a vehicle or part of an international reserve system. You got the head of the IMF coming out 2 weeks ago and saying that CBDCs need to be backed by something in order to give them stability. You have all of the European central banks repatriating their gold from the New York Fed and the Bank of England. You have central banks buying more gold over the last 18 months than at any time in history, the biggest first quarter ever on record by the central banks. My feeling is that the only way that this really truly works is by pegging it to gold. But why now? I'll tell you why. Jim Rickards just came out, and I've been saying this for 3 years. In every interview I've done for 3 years, I've been screaming the BRICS going to issue gold-backed currency. What did James Rickards just say? August 22nd, the South African meeting, he believes they will issue or introduce their new commodity-backed currency. Now, they told us it will be backed by a basket of commodities, gold included. Jim Rickards thinks that becomes too convoluted, that it will most likely just be gold. What did the IMF just say? Gold's not a barbarous relic no more, ? What did the head of the IMF just say? CBDCs need to be backed by something. I was asked this question in Vancouver by Michelle McCory from Kitco. What do you think could derail or challenge the BRICS in issuing this currency? And by the way, the BRICS and the Belt Road Initiative and the Shanghai Cooperation Organization and the New Development Bank, well, by the way, OPEC is Saudi Arabia is involved in every one of those institutions, every one of them. All the OPEC countries are on the Belt Road. This is a trend where the dollar's hegemony is being called into question. And I think if I'm OPEC, if I'm Saudi Arabia, would I rather sell my oil to a country that has chosen inflation over austerity, that is inflating away their currency, that is going green, that is not supporting the combustion engine fossil fuel agenda, in fact, is pushing back against it and moving away from it, and is openly antagonizing Saudi Arabia in that respect. Do you think they want to sell us their oil, or would they rather join up with an amounts to 90% of human population that is going to issue a commodity or gold-backed currency, and they're all using oil. So all of these things are spinning very, very quickly. But my real feeling is that the reason you're hearing about all of this stuff right now is that there is a very strong and somewhat substantiated rumor that they're going to issue a commodity-backed currency to challenge the Western hegemony as soon as August 22nd. So
I wrote that date just down. Yeah, so really
it,
curious. Maybe that's why they won't let France attend the event as well. So
yeah, I just noticed that Macron asked to be invited and he got rejected. That was a little surprising to me, especially since he signed a 51-point trade agreement with China, ranging from 5G to military engagement, and bought a tremendous amount of liquid natural gas in yuan. So yeah, things are in flux. And when you see our allies like France making these overtures, or Mexico joining the BRICS, or Saudi Arabia, or Turkey, Egypt, all these countries that the West has been friendly with are now really, it seems as though they're choosing sides, including the United Arab Emirates.
Yeah, no, absolutely. And we probably have to, organize another conversation here to talk geopolitics, because what is happening in the Middle East since the departure of the U.S. Army, pretty much since the retreat, is really, really interesting. But let's talk commodities. Let's talk gold. We need to talk a bit gold and silver price developments over recent months here as well. Gold is hanging in there. It's a question I've asked lots of guests before as well. Is like, why is gold hanging in there? Should it be hanging in there? Should it be higher? Should it be lower? What's your opinion?
Well, I mean, it's hanging in there because the central banks have bought more than in any time in history over the last 18 months. It's hanging in there because the big money understands that it is wealth. It's hanging in there because it in fact should have been doing a whole hell of a lot better based upon the fundamentals. But when you look at it from a traditionalist standpoint, yeah, with rates rising, that is kind of the environment where gold would languish a little bit. But it's important to understand there is a term in economics called Gibsons Paradox, which speaks to the inverse relationship between the price of gold and real interest rates. Now, even though you got interest rates on the 10-year Treasury barely at 4% right now, but the federal funds rate at, I don't know, 5 or whatnot, you have inflation much higher than that. We are below the level of inflation. And if you're buying a 10-year Treasury, in fact, I'm going to cheat right now, and I'm just, while we're talking, 10-year Treasury yield is currently
3.72.
3.7, right. So you've got 3.7 on a 10-year Treasury yield, yet your inflation by the line CPI standards is basically double that. And if you take a look at what John Williams of Shadow Stats would tell you, using just the metrics the way they used to be calculated before they changed the metrics to meet their inflationary agenda, we would be almost 3 times higher than that in terms of inflation versus yield. So when you talk about real return, your negative real return right now is at least 3% compounding if you believe their numbers, and potentially as much as 7, 8, 9% compounding. And so gold should really do well in this environment, in a real negative yielding return environment. Look, the bottom line is that gold has been suppressed for so long by the West in an effort to support the bond market, in an effort to support this illusion of a strong dollar. And at the same time that we are seeing the dollar or the price of gold get hammered, let's talk about something real quick in terms of what we've seen with deliveries off of COMEX. The biggest money in the world, the most sophisticated money in the world, has been draining COMEX and draining the London Metals Exchange to a level that we've never seen before. Massive deliveries coming off of the exchange month over month over month. Let me see if I can get you some actual numbers here, which will, I think, make a lot of sense to what we're talking about. If we take a look at Here it is, right here. Okay, central bank gold purchases we mentioned, and it's really growing. I mean, Singapore up 35% in the last 3 months. Central Bank of Iraq adding 2.5 tons. Turkey, everyone's buying gold, but when you take a look at what's happening in terms of the deliveries off of COMEX, I want to see if I can find this. Here we go. Okay, so in terms of deliveries off of COMEX since the beginning of the year, we've seen somewhere almost near 250 tons of gold delivered off of COMEX since the beginning of the year. And I had a surgery last week. I was laid up, and as I'm laying around last week, I'm looking at the delivery numbers. And I noticed last week that the 7 days previous, 55 tons had been delivered in the 7 trading days that, leading up to last week when I was reading this. This is unprecedented numbers of deliveries. And so when you talk about gold and silver being drained off of the exchanges, it's happening. Over 12,966 silver contracts, or over 65 million ounces of silver, has stood for delivery off of COMEX since the beginning of the year, almost 13,000 contracts. You're talking a situation where the biggest money in the world has been using the suppression of the paper price to drain the exchanges, whether it be the LBMA, the COMEX, the Shanghai Gold Exchange, or the central banks, who have, as we've mentioned, for the last 18 months bought more than they ever have. So that's why it's hanging in there. But the conventional wisdom is telling you in a rising rate environment that gold should be doing poorly, and it just allows them to beat down the price with rhetoric and suppress the price with paper contracts. And when you talk about how they do that, I'm going to use silver as an example, right? Because it's very important that people understand just exactly how they do this. About a week ago, when the price of silver got clobbered, some idiot dumped 25,890,000 ounces of silver onto the market in 15 minutes, or 5,178,000 5,000-ounce contracts of paper like that at the open in New York. Now, who would do that? Why would anyone dump that kind of volume at the open? You're guaranteed the worst possible settlement. That trader should be shot and fired, and maybe in that order. And so the point of it is that it reeks of desperation. The big monies are doing what they can to hold down the paper price. Maybe it's in an effort to drain the exchanges. Maybe it's in an effort to support this illusion of strength of dollar and stability. But any way that you cut it, the bottom line is this, Kai. The price is being betrayed by the most well-funded and well-informed, sophisticated investors on the planet, draining all of the world's exchanges. And that's a trend that we haven't seen abate over the last 2 years.
No, really interesting developments, because I was a bit confused. We had ETFs sell as well just before the banking crisis, and then the numbers sort of turned around a little bit as well. That's why I'm surprised gold isn't actually higher than it is. But you mentioned rhetoric, and I keep bringing up that Fed Chair Powell keeps sort of, I would say, dangling a carrot, but he keeps hinting at higher rates to come, meaning he's taking the wind out of our sails, the fuel out of our rocket ship here, right? But by using rhetoric like that as well.
And again, it just shows how naive the whole system really is, because again, we're talking, I don't care if he raises by another full point, you're still, real return is negative. And they say, well, gold doesn't pay a coupon, there's no interest. It sure beats the hell out of going backwards or a negative real return. So when the most sophisticated investors on the planet are accumulating it, when the Bank of International Settlements calls it tier one, when the central banks repatriate it and go on a massive buying spree, that's all you need to see. And understand that the sophisticated money is always 4 or 5 steps ahead of the rest. And this is what they are doing. They are using gold as a vehicle to de-dollarize and using the Western suppression against us. If you look at they just came out with, and I think it probably was maybe March or April, they just came out with the export numbers, gold from the Swiss refineries, the biggest refineries in the world, and they're always a few months behind. But the 3 biggest, the largest exporter of gold in the world was the United States to the refineries in Zurich. The 3 biggest importers, China, India, Saudi Arabia. I mean, so the countries that are accumulating it, they know damn well what they're doing. And the people in the West, the institutions in the West that are shedding gold, selling gold, or sending it over to be refined and sold, this is a one-way ticket. This stuff's never coming back. And I think you can see that a good portion of the world looks at gold as money. And I don't think the final chapter for what gold is going to do here in 2023 is anywhere near being written. Although I do expect a little bit of weakness here over the next couple of weeks, simply because of the rhetoric of rising rates and of Powell coming out and saying just recently, maybe even today, I think he was talking, saying that, yeah, that we expect probably 2 more rate hikes, the next 2 meetings of rate hikes. And it wasn't a pivot, it was a pause. Well, you know, I think there's some conflict in there because they know that if they continue to raise rates, that you're going to see more and more issues with the banks, with commercial real estate, the fallout of the small businesses, all of this tied together. You know, they're in a tough position. But look, they're raising rates all around the world. You're going to continue to see it with the Fed too, and
2% inflation target. That's the goal,
yeah.
right? So
can you imagine Elon Musk standing on stage and saying the goal of Tesla is to lose 2% per year? It's funny that we think that 2% is a good thing. It should be negative 2%. The lower inflation, the higher the standard of living. But there's still a long hell of a way away from 2%. And you're going to have to see much higher rates for that to happen.
absolutely. Andy, let's say we can't close this conversation without talking about silver in general. Like, let's talk silver bullion. How are the sales developing? How are the premiums looking right now? You're my go-to source here.
I appreciate that. The lowest premiums I've seen since the pandemic, the best availability I've seen since the pandemic. And we're talking 3+ years. And it's interesting because we added 14,000 clients in March and April, and it was insanity. And stuff started to disappear again. Over the past 3 years, getting product and high premiums has become a challenge. And right now, again, the eye of the hurricane. Honestly, it is the best availability, the lowest premiums, and the immediate delivery that I've seen since March or April of 2020. Again, I look at this as the calm before the storm. It doesn't make sense to me. People in this country suffer far too much from recency bias and normalcy bias. And I think they're all hoping, optimistically, that the worst is behind us. And as a result, the interest in physical precious metals is still very strong in its relative comparison to the last several years or the last decade. But over the last 18 months, no, it's slow right now. And that's created, in my opinion, the very best environment I've seen in 3 years to accumulate affordably and expect to receive it immediately. And that hasn't been the case for the most part of the last 3 years.
Interesting. I have to ask a cheeky question, Andy, and please forgive me asking that. But what you just described sort of seems like supply chains have been sort of repaired, restored. Something that was broken seems to be fixed now. Can we translate that to the inflation debate? So, because we were saying, well, the inflation numbers are all rigged. A lot of like the transitory discussion of the inflation. I'm curious if we can sort of take the, let's call it the bullion supply, into the other discussion. It's just something that popped in my head. That's my last question for today.
Well, I guess, I mean,
right?
I'll try to answer it best I can. When they said, when they came out and said it was Putin's inflation, I figured they're looking for a villain. They want to blame it on someone because inflation is never about supply chain distortions. Yes, that increases the price inflation of certain segments of the economy. Yes, the war certainly did impact supply chains. The pandemic did impact supply chains. But what inflation is, in a technical sense, according to Austrian economics, is 100% of the time a monetary event. It is an increase in the money supply. What have we done over the last 4 years? We've printed more money than the history of the country preceding it. That is inflation. And by blaming it on Putin, you deflect responsibility and you create a villain. And so if we contrast that, compare and contrast that with metals, sure, the pandemic and the war could have had effect on supply chain distortions, but the real reasons to buy gold have nothing to do with supply chains as much as they do the underlying cause of the problem, and that is massive inflation caused by brain-dead monetary policy and suppression of interest rates, creating huge distortions across the entire financial landscape, and a system that I think lacks not only transparency, but lacks trust. And I think, that's one of the things you could argue, and I know that's not what you asked me, but we are losing trust as a nation, especially in even the rule of law. And so when you talk about the mismanagement and the squandering of the privilege that is the world reserve currency, in order to make a new system work, you will need trust. And I think the reason behind buying gold and silver and the prices and the premiums, look, it has less to do with supply chains. Yes, that certainly is a factor. But right now, too many people believe that we're out of the woods, and they're looking to other areas like that will change if you see a couple of banks fail, and the ramifications, the reverberations that we'll see around the globe. People will remember, or at least here in North America, will remember exactly that, hey, maybe things aren't so great. Maybe we do need to add some gold and silver to our portfolio because inflation is not going away. And I'll say it one more way this way. They talk about a $32 trillion debt in this country that we just finally eclipsed for the first time ever, 32 trillion. And I always like to say to people, look, a trillion is a big, big number. A trillion seconds ago was 31,688 years ago. It's a huge number. But assuming we have a balanced budget today, trying to pay off that $32 trillion debt, sure, we could do it. It would be a noble endeavor. It would be hard to do. I don't know how we would do it. We would try to produce our way out of it. Kind of hard to do when we don't produce or manufacture much of anything. Now, of course, we can tax our way out of it. That's not going to be very popular. But let's say we figure a way out of it, and we reduce spending, and which is the hard part for the government to do. And look, if we go back to 2019, we took in $5.5 trillion in tax revenues and spent $4.5 trillion. We had $500 billion to put towards, if we wanted to, paying down the debt. The problem is this year we're going to take in 6 and spend 7.5, whatever, something like that. And so we're going the wrong way. But I guess the point that I'm trying to make is that ignores the elephant in the room. How about $77 trillion in IOUs in Social Security? How about Medicare and Medicaid and government military pensions that, by the government's own admission, exceed $140 trillion? How the hell do you ever pay that off without inflating away the currency? Inflation is here to stay. And as my mentor, God rest his soul, always said long before any of this stuff ever became visible, he's been dead for several years now, Richard Russell, that the Fed has no choice but to inflate or default. Inflate or die, he always used to say. And that's where we're heading. So again, people need to broaden their horizons. They can't just look on the here and the now. They have to see the macro picture. And the macro picture, in my mind, speaks of ever increasing inflation and deficits and a problem that's not going away. And maybe this is why you've seen such a concerted effort by the biggest money in the world to quietly, using Western price suppression of price and rhetoric, to drain the exchanges and to accumulate more on central bank level than we've ever seen before. They know what's coming. They see the big picture. They see the macro picture. And everyone here who is just focused on the here and now is they don't see what's coming, and they're not getting out of the way of it. So look, to your point, Kai, look, this is going to be it's not going to be easy to hang on. The bull's going to try to throw you off at every turn. But as far as I'm concerned, we ain't seen nothing yet. And I think it's going to be very bumpy leading into the 2024 election.
Yeah, I was joking yesterday in an interview. The bull is epileptic, definitely. So
100%.
Absolutely. Andy, phenomenal.
Maybe schizophrenic.
Absolutely. Phenomenal conversation, Andy. Thank you so much for your time. Fantastic insights. Where can we find more of you? MilesFranklin.com?
Yep, milesfranklin.com. Any questions people have, info@milesfranklin.com. Happy to answer them. Andy@milesfranklin.com, personal email that people want to send me messages, and always happy to talk with your people. We have a hard time sending product to Europe these days. Anywhere in North America is never a problem. We have what I also believe is the finest, most enviable storage program in North America. For your listeners that are interested in that, we can help with that as well. But Kai, it's always a pleasure to see you. I follow you from afar. I look forward to seeing you in Vancouver again this winter, but hopefully we'll chat again once
October in New
more.
Orleans. We're going to be at Brian's conference. You're going to be there, right?
I'll be there. I'll see you
Okay,
then.
fantastic. Andy, all the best. Good luck. It looks like there's some heavy clouds rolling through Arizona there, so be safe out there. And everybody else, thank you so much for tuning in. We hope you enjoyed this conversation. I know I did. Lots and lots of info in there. Andrew said it best, but let's look at the macro to understand the micro. Right? That's the goal. That's the mantra here at Soar Financially. If you enjoyed this conversation, sign up, subscribe. Here's the button, roughly there. To our channel, hit that like button, leave a comment, engage with us. Andy's reading the comments, I'm reading the comments. We'll get back to you, right? Make sure to do that. Thank you so much. It helps us tremendously. When we grow, we can bring guests like Andy back more frequently and other guests as well. Thank you so much. We'll be back with more.